Hi everyone, and this is a screencast for Independent Colleges Dublin for ACCA P6 Advanced Taxation for the June 2014 exam. The area that we're going to cover within this particular screencast is Case 1 and Case 2 self-employment and partnerships. There will be a Part 2 as well, dealing with partnerships and one or two other areas. So in terms of Case 1 and Case 2, I think the first thing that we need to run through is this area of what does it mean to be taxed under Case 1 and Case 2, and indeed, what is a self-employed person? Well, essentially a self-employed person is a sole trader who is trading, in other words, trading in a particular good or service. Now, the area that John Morrison, your examiner, can examine and has examined before is this area of whether or not a person is actually self-employed. In other words, are they trading, or perhaps are they doing something else? And what has sort of transpired over the course of the last sort of 100 years or so is just really a set of rules. In other words, a set of rules that the revenue would bring into play to establish whether or not someone is trading. So if you think about it, what the revenue want to do is obviously to classify people correctly for tax purposes, but they also want to make sure that they collect as much tax as possible. So really one of the areas that we're going to cover here is really if a person isn't trading and they are taxable, then what are they taxable under? Well, it's more likely that they will be under the CGT or capital gains tax banner. Or it could well be that an individual is trying to suggest to the revenue that in fact they aren't trading or they aren't selling a chargeable asset for CGT purposes, that they're just holding an asset and they just happen to sell it for personal reasons. So therefore perhaps tax is not due. Okay, so the issue here is a series of really what we would call badges based on case law and court cases over the last sort of 100 years or so. And there's several important cases. You don't need to know the details of the cases, but what you do need to know is what is meant by a badge of trade. In other words, where a person is seen to be trading, what sort of parameters or characteristics are there in relation to that person's trade, or indeed otherwise if they're seen to be taxed under CGT. And there's sort of simple mnemonic here. Hopefully you can see all of it so firm. And really, for me, this summarizes the main areas that you would need to consider. So I'll just touch on one or two of those. If we look at, for example, O for ownership period, really what we're saying there, if we're looking at individual circumstances, and perhaps the revenue are also looking at it, what we're saying is that if an individual holds an asset for a short period of time, it may well indicate that that is of a trading nature, or perhaps they have a series of assets and they've held them for short periods of time. The revenue would look at that and say, well, this is unusual. You're obviously not using that asset on a personal basis. It seems you're holding it for a week or a month and then you're getting rid of it. Why are you doing that? It seems to us that you are trading. Okay. Similarly, and linked into that, the frequency of transactions. If someone is doing repeated transactions, every week or twice a week, that would tend to indicate that someone is trading. Okay. Other areas to look at perhaps are, are for reasons for sale. In other words, if the individual can show that they were really forced to sell the asset because of some particular circumstances, that it may well be that that can be shown to be someone who isn't trading. In other words, they weren't doing it regularly, there wasn't a lot of transactions, just for one or other reason they were forced to sell this particular item and indeed make a profit, but they're not trading. So I'd ask you to sort of learn that mnemonic, work the questions in this area and sort of just be familiar with, how to lay out an answer using these 7 points, 6 points even. Okay, One thing I would bear in mind on this, and indeed the other mnemonics that will come into play within the advanced taxation syllabus. For example, we looked at one called MICE RAN in relation to employment versus self-employment. Is, a nice little tagline that you can use is really that no one factor is conclusive. So if you were writing a narrative relating to a certain individual circumstances, a nice way to close off it would be that the revenue would look at all the circumstances. It would be based on perhaps the balance of probabilities, and really no one factor would be conclusive. They would look at all the factors. So just bear that in mind. I mean, that shows a nice bit of knowledge, and you're sort of making friends with your marker by making quite a professional point like that. Okay. So moving on, if we were to assume that the individual is trading, then, for an individual, what do we do? So the individual provides us, let's say we're working in public practice as an accountant, the individual provides us with their set of accounts, their accounting profit. Let's say that it's 40,000 euros. Now, what we know is that the individuals will have perhaps claimed things, will have claimed deductible expenses that aren't allowable. And they may well have included within that accounting profit items that are not taxable under case 1 or case 2. So really, we need to adjust the accounting profit that the individual provides us with for tax purposes. We need a tax-adjusted trading profit. What I tend to call this area, because I've been in practice for a little while, is I tend to call it the sort of the brown paper bag situation, where the individual is walking into your office, providing you with a profit and saying, Paul, my profit for the year is £1,000, when in fact it isn't. We need to adjust that for tax purposes. So really, how do we do it? Well, it's fairly straightforward. We take the profit per the accounts, we add back disallowable expenditure. Here's some of the classic ones, and then we deduct cap allowances to get our adjusted trading profit, i.e. the IT comp figure. So in essence, what we're doing is we're going from the individual's profit, and we're adding back disallowed items, taking off cap allowances, which is the inland revenue's form of depreciation for wear and tear, and coming to an adjusted profit figure for tax purposes. Okay, now at P6 advanced taxation, it's highly unlikely that you'll be asked to do this for case 1 and case 2, at least for an individual. You may well be asked to do it for a corporation, for a limited company. Okay, so basis of assessment. If we assume that we've had the brown paper bag into our office, we've adjusted it for tax purposes, well, how do we get that figure into the income tax computation? Well, really, there's a general rule, and then there are a series of slightly more complicated rules. Now, the general rule is that if an individual is making up a set of accounts to a given date, and the individuals are entitled to choose any date, 30th of June, 30th of September, 31st of December, whatever they want. Now, if they are doing that, we need to have some sort of level playing field. In other words, we need to be able to chop the accounting information or the accounting period up into tax years, because not everyone is going to choose the 31st of December tax year. Okay, and really what that means is that we're looking for a basis period. And the normal rule, known in the UK as the current year rule, similar within the ROI, what we're saying, the normal rule is that if an individual makes a set of accounts up for 12 months to an accounting date, let's say 30th of June 2012, well, that accounting date ends in the 2012 tax year. And as a result, that accounting date is the basis period for that tax year. In other words, it's the accounting period of 12 months ending in the tax year. Okay? So that's for an ongoing business. That's a normal situation where you have someone who is trading year on year. But there are some exceptions to the rules, and those are the types of things that John Morrison, your examiner, is going to examine. In other words, the exceptions to the normal rule. And there's 4 here. We're going to deal with first 2 in this screencast. And the first 2 exceptions were really at commencement and cessation. We'll deal with short-lived businesses and change of accounting date in the next part 2 screencast. So do bear in mind that this is an area that students do have difficulty with, and that makes it very, very examinable. I wouldn't walk into the exam in June without being able to bang out these qualifications very, very quickly and accurately. Okay, so let's deal first with commencement. Now bear in mind, commencement doesn't follow the normal rules, so it's not the accounting period ending in the tax year. Commencement is straightforward, at least for the first tax year. So we have a question in June, and it says that John Doe commenced trading on the 1st of July 2012, and we're required to come up with a basis period for that individual. Really, the first tax year is from commencement through to the 31st of December, the following 31st of December. So fairly straightforward, and in effect what we're going to have to do is prorate the accounting information that we give the adjusted tax figure based on the commencement date through to the 31st of December. Now, in our example just there, starting at the 1st of July, it'll be 6 months. And really what we call that is actual. In other words, what was the actual performance of the actual trading profit from start date to the 31st of December. Okay. Here's a pretty straightforward example. In fact, using the dates that I've just given, we have someone who is a florist, started on the 1st of July, had taxable profits for a year through to 30th of June 2013 of £8,000, 8,000 euros even. And what we're looking to do is simply cut out the element that relates to the 2012 tax year. And the way that we do that very simply is take the actual performance from start date to the following 31st of the 12th, which is in effect 6/12. Okay, so pretty straightforward. Okay. In terms of the second tax year, this is an area, as I've said, that students do have some problems with, and really there are 4 main rules, and this is a cut and paste directly from the FA 2012 text. This information won't change for FA 2013 at all. This has been set for many, many years. Now that may well lose a little bit in translation in terms of your understanding. So what I've done on the next slide is just break it down to something a little bit more simple, but sort of still works if you think it through. So let me take you to that slide so that we have something that sort of we can work with, as it were. So we're talking about the second tax year, and we're saying what's the basis period for the second tax year? We know that the first basis period is actual, so we've gone from start date to following 31st of December. So in the second tax year, what we're saying is that there's 4 possibilities. Okay, the 4 possibilities really are centered around, or at least the first 3 are centered around, is there a 12-month accounting date ending in the second tax year? Yeah, and if there is, what we're going to do is take the latest accounting date. Yeah, so the first 2 areas, you'll notice that 1 and 2 are the same here. If you read the previous slide, it's slightly different, but essentially it does work as long as the accounting period is 12 months. So really for 1, 2, and 3, the questions that we're asking ourselves are, what is the accounting date ending in the second tax year? Or indeed, is there one? Okay? And if there is one, is it 12 months long? Let's take the 12 months to the latest accounting date in the second tax year. Okay? Now, if there isn't an accounting date ending in the second tax year of 12 months, then in effect, what we're going to have to do is to take the actual period. In other words, the 1st of January through to the 31st of December. So again, a little bit like the first tax year, except it's for a 12-month period. Okay. So the way to learn this area, and as I've said, this does cause students a lot of difficulty. The way to learn this area is not so much rote learning, but really doing questions over and over and over again. And you can be sure that John Morrison, your examiner, he has taught at P6. He knows the areas to push on within this syllabus, and this is definitely one of them. Don't walk into the exam in June without having a firm fix on year 2 and these basis periods and indeed this chapter. Okay. So in terms of an example here, we've got, this is for year 2, we've got an individual commencing on the 1st of May 2012, preparing a first set of accounts to 30th September and a second set up to the 30th of June. And we're provided with the tax adjusted profits. So those are already adjusted, 15 and 27. So what we're looking to do is to calculate the case 1 income for 2012. So really what we've got to do in terms of laying out an answer, we've got to say, well, I probably would calculate the first year will be start date to the following 31st of December, but it's the second year that they want. So the second year, remember that there are 4 rules, okay? 4 rules. The first 3 are very much, is there an accounting year of 12 months ending in the second tax year? So I'll just give you a moment just to look at this situation, bearing in mind that we know that year 1, i.e. the first tax year is 2012. That must mean that year 2 is, the year 1 is 2011, year 2 is 2012. So really what we're saying is, if the second tax year is 2012, we're saying, is there an accounting period of 12 months, but at least 12 months, ending in the second tax year? Okay, so have a quick look at that and we'll come on to the answer. Okay, so what we find out is that the basis period for 2012 is the 12 months ending 30th of June 2012, because there was an accounting year of 12 months ending in the second tax year, and if there is, that's what we take. Now, what that requires us to do, as you can see here, is really chop up the accounting information that they've given us. In other words, they haven't. If we look just back to the previous slide, she or the writer of the text hasn't given us the exact information that we need. What we've got is we've got a period up to the 30th of September 2011, and then a second set of accounts up to the 30th of June. So we're required to really prorate. So you'll see that we've got really 3/5 of 15 at 9, and then the balance of the period 1st of October to the 30th of June at 27, giving us the total amount for the basis period 1st of July 2011 to 30th of June 2012. Now, just one word of advice in relation to laying out these answers. I would be very clear, perhaps even clearer than this question is, as to your workings. In other words, lay out the basis period, actually write it out just like that they have done, and also lay out the tax year, perhaps above here, tax year 2012. This is the basis period, and this is the cut up of the accounting information. So do that, then do the next year, okay? Try from the off in your studies to get familiar with how the answers are going to be laid out. If you don't do that, what you'll find is when you're bombarded in the exam with much more information than this, it becomes easy to get very, very confused. So take it slowly when you're learning. Try and get your formats right, okay? Right, next example here is in relation to Dorothy. She's commenced trading on the 1st of November 2011, first set of accounts up to 30th of June 2012, and then another set after that. So again, we're asking ourselves the questions of, really, which one of the 4 rules for year 2 is going to come into play? Now, you remember that the first 3 really center around, is there an accounting period of 12 months ending in the second tax year? Okay, so again, we know that the first tax year, because she commenced in the year, is 2011. That must mean the second tax year is 2012. So really what we're looking for is a set of accounts of 12 months ending in the second tax year. So I'll give you a moment just to look at this example. Okay, so what you'll see here is none of the rules apply. In other words, there isn't an accounting period of 12 months ending in the second tax year. Okay, there is a set of accounts ending in a year, but it's not 12 months, and we need 12 months. Okay, so in effect, because she wasn't trading for that period prior to commencement, obviously, we have to use the 4th rule, which is actual. So again, as you can see here, very clearly, basis period, actual. 1st of January 2012, 31st of December, we're simply cutting up the accounting information, giving us 12 plus 18 equals 30. Okay, so that was a good example of the 4th rule coming into play, the actual basis, a bit like year 1. Okay, so the 3rd year, again, you remember when we started off on this area of basis periods, we said that the normal rule for an ongoing business is to take the accounting period ending in the tax year. And the 3rd year is just that. It's quite straightforward. It's the accounting year bear in mind, accounting year, 12 months, ending in the third tax year. So quite straightforward, no cutting up to do with that one. Okay, now one thing that is relevant to the third year is just this area of the second year excess trick. Now I would say if basis periods come up in excuse me, in June 2014, I think it's highly likely that this is going to come up. Okay, because it's a little bit unusual. Okay, and all that we're saying here is that if for your second year the profits, the assessable profits, so in other words, once you've done your calculations based on those 4 rules, under the normal rules, if the profits that you are assessing are greater than the actual second year profits, in other words, from 1st of January through to 31st of December, if they are, we need to deduct the excess from year 3. We have to deduct it from year 3. So a little bit unusual, but just remember, if you get a commencement and you're asked to lay out basis periods for several years, 1, 2, and 3, there's going to be, it's highly likely to be some sort of excess to be deducted from year 3. Okay, let's have a quick look at an example on that. So this is on page 71 of the BPP text for 2010. So we have an individual who's commencing in 2010. We know that that's year 1, therefore year 2 is 2012, year 3, 2013. So she's got an accounting date, 31st of July, and we've got 2 sets of profits. So what we're looking to do is to calculate the assessable profits for 2012, okay, rather than assessable profiles. So we know that that year is the third year, so we should have twigged really there's going to be this second year excess trick. So we have to go through the motions and do our calculations, and then just remember to compare the second year's results on a normal basis to an actual basis, and if there's any sort of excess, then deduct, okay, from the third year. Okay, so let's have a quick look at this. So what we've got here is, I'm running out of space here, bear with me. Okay, so what we've got here is the period for the second year, 31st of July 2012, that is the basis period, okay? Now the profits for that basis period as given in the question were £24,000. So we actually need now to compute what the actual second year profits are. In other words, under the normal rules, we had the year ended 31st of July 2011 as the normal basis period. Okay, because that was the 12 months ending in year 2. But what we need to do now is compare that figure, so compare the 24 to the actual results for the year. So we have to really go back to the accounting information and cut it up again. And as you'll see, what they do within this calculation is simply take 2 distinct periods, we had to cut it up into 2, and calculate the values based on those 2 periods. Note that we have 7 plus 5 equals 12. So what we then get is a total of 21,500. And if you compare that figure to the figure up here of 24, you can see that on an actual basis, the values were lower. So there is, in fact, an excess. So if there is an excess, what do we do with it? Well, we've got to deduct it from the year 3 assessable profits. So they then come down from 18, which would have been the normal basis on the current year ending in year 3, down to 15,500. And 15,500 is the figure that we would put into the income tax computation. Okay, so cessation. Okay, another couple of fiddly little rules here, but nothing to worry about. Just work the questions and it'll become clearer. In terms of the detail here, really, the cessation year, the final year, the year in which the individual ceases to trade, is fairly straightforward. Because if you think about it, what we'll be given is a cessation date. We'll be given a date on which the individual ceased. And all we'll need to do is to go back to the 1st of January in that tax year and take the basis period as the 1st of January through to the cessation date, bound to be less than 12 months. Okay? And that is, in effect, actual. So the final year is quite straightforward. It's simply actual. Let's look at a quick example on that. We've got an individual who's ceasing on 30 September. So they ceased in 2012. So his accounts are made up to the 30th of November, and we're given some accounting information. Notice that we're not giving full years. Okay. So what they're asking us to do is to calculate the case 1 income for the final basis period. Now we know from the previous slide that that is going to be actual. So the basis period has to be actual. So it really has to be the 1st of January 2012 through to the 30th of September 2012. And I make that 9 months. Okay, so let's look at the example, or the example solution here. So as you can see, basis period 1st of January 2012 through to the 30th of September. And really all that we had to do with the accounting information we give, that was the tax adjusted information, we have to say, well, it's only 9/10 of that because the basis period is only 9 months long. Okay, I think we were given a 10-month accounting period. And there we have our basis of assessment for the final year. So fairly straightforward. Okay, now one thing we need to do, again, a little bit like the second year excess trick, is where we have a cessation, we've actually got to look back at the penultimate year. Yeah, another little trick, and excuse my slightly quirky slide here, but I'm just trying to get you to remember what you need to do. So any cessation situation for an individual, we have to look back at the year before the final year. Okay, so in our case, I think the final year in the previous example was 2012. So for me, the penultimate tax year must be 2011. Okay, now if you think about it, for an ongoing business, in the penultimate year, the individual was just trading as normal. Perhaps he didn't know that he was going to be ceasing in the following year. So if the penultimate year is a normal year, and invariably it will be, we have a situation where the penultimate year would be taxed on the normal basis, i.e. the accounting year ending in the tax year. So just in the UK, they call it the current year basis. So you remember it was the first rule that we talked about when we touched on basis periods. So really, this rule says that, yeah, okay, you can have your normal basis period, i.e. the 12 months ending in the year for the penultimate year, but you need to compare that to the actual period. In other words, the actual profits, the actual results for the actual penultimate tax year, in our previous case, 2012. And once you compare them, you need to actually take the higher value, yeah, rather than the lower value, the higher value, okay? And that becomes your assessable amount, okay? So in this example here for Larry, we're using the previous example. Bear in mind, this is BPP text, page 72 for FA 2012, okay? So the previous example, if we had a 12-month set of accounts ending in the penultimate tax year and the profits were 24,000, we need to look at the actual performance in that actual tax year, okay, 2011. And in this case, we look at it and we chop up the accounting information. Notice that it says 1st of January there and 31st of December here. So all we're looking to do is to take the accounting information and chop it up and compare it to actual results, okay, on the normal basis. So what you'll see is that on the normal basis, the accounting period of 12 months ending in the penultimate tax year was 24,000 euros. But in our case here, the adjusted or potentially adjusted figure was 23.5. Okay, so the original assessment must stand because it's higher. Okay, so a recap. This is an important area for you, very, very commonly examined. And as I say, the examiner knows that students, don't like this area. Sometimes they tend to avoid it. You'll get it really by working the questions as often as possible, preferably under exam conditions. I'd ask you to sort of watch your format. So, watch how you lay out your answer. Let's have basis period, this date to this date, tax year, actual, and then let's do our calculations. Let's leave that year, then move on to the next year. Watch out for the two tricks that we've touched on here, which is firstly the second year excess trick, where we've got that excess that we have to deduct from year 3, and then watch out for that penultimate year rule as well. Okay. In terms of a sort of closure on this, hope that's been helpful to you. Do look out for the next screencast, which will cover the other exceptions, the short-lived businesses, and also partnership rules. They're also very, very examinable, and good luck.